Gold just climbed back over $5,000 again. And the part that matters isn't the round number, it's the behavior around the number. Because when gold reclaims a level like that after a rough stretch, it's not just a headline, it's a test of whether buyers are real, whether selling pressure is exhausted, and whether the market is being supported by something deeper than the daily news cycle. And right now, the cleanest explanation being discussed isn't some magical one reason. It's flows. Not vibes, not slogans. Flows. The kind of flow that shows up when dips don't stay dipped. The kind that makes price feel heavier on the way down and lighter on the way up. The kind that makes people say, why won't this thing break? And a big piece of that flow story is being connected to China, but I want to do this responsibly, because it's easy to turn China flows into a dramatic conspiracy phrase. And that's not what we're doing here. We're going to keep it tight. We're going to focus on 2 concrete flow signals and 1 official signal. That's it. Because if you try to explain gold with 10 reasons, you end up saying nothing. If you focus on a few measurable tells, you actually learn something. Quick check so I know who I'm talking to. Type price. If you mostly follow charts and spot, type flow if you track demand and behavior, or type both if you've learned the hard way that price is the scoreboard and flows are the game. All right. Here's the first thing you need to understand about a number like $5,000. Round numbers don't move markets. They collect attention. They become psychological magnets. They become places where traders cluster orders, where risk managers set triggers, where algorithms react, where headlines get written, and where emotions pile up. So when gold gets back above $5,000, it doesn't mean the world changed overnight. It means we've reached a point where the market has to reveal its posture. If the level holds, it tells you dips are being absorbed. If it fails quickly, it tells you the move might have been mostly a squeeze or a short-term burst. So instead of getting hypnotized by the number, ask the better question. What kind of buying is strong enough to keep gold supported up here? That's where China flows becomes a useful conversation, if you keep it grounded. Because China flows is not one thing. It's not a single lever someone pulls. It's a combination of demand signals that can create a floor and sometimes a surge, and sometimes a volatility spike depending on positioning. But again, we're keeping it disciplined. 2 flow signals, 1 official signal. Here we go. The first flow signal is Shanghai pricing behavior, especially the idea of a local premium versus Western reference pricing. You don't have to be an economist to get why this matters. If a region is consistently pricing gold higher on a translated basis, it suggests there's urgency in that local market, whether from investment demand, savings behavior, or physical procurement dynamics. That premium doesn't guarantee a straight line rally, but it's a tell. It's a signal that demand is not just theoretical. It's reflected in what people are actually paying in a major marketplace. And here's why that's important. Gold is global, but liquidity and demand are not evenly distributed. Different regions can pull harder at different times. So when Shanghai is firm relative to the West, it can be one clue that Asia-side demand is contributing to resilience. Second flow signal, China-linked gold ETF inflows. ETF flows matter because they're a snapshot of investor behavior that can be sticky. This isn't the same as a day trader hitting buy for a 10-minute scalp. This is allocation behavior. When a large pool of investors decides gold is where they want to park money, especially during uncertainty, that creates a support layer under the market. And if those inflows persist across weeks and months, the market's character changes. Pullbacks get shallower, breakouts hold more often, and price starts acting like it has a bid underneath it even when sentiment looks messy. Now the official signal, reserve updates, and central bank accumulation narratives. We don't need to oversell this. Sometimes reported reserve additions are small. Sometimes they pause. Sometimes they resume. But even small additions can matter psychologically because they tell the market, an official buyer exists, and they're not trading for tomorrow. They're positioning for years. That shapes expectations, not because it guarantees price goes up tomorrow, because it makes people less eager to bet aggressively against gold on dips if they believe those dips might have a buyer underneath. That's the tight framework: Shanghai pricing behavior, China-linked ETF inflows, reserve update narratives. Now here's the part most people miss, and this is where you separate signal from noise. If China flows are truly meaningful in the current regime, the evidence won't be clearest on big green candles. It'll be clearest on ugly days, because rallies happen for 100 reasons. The real tell is, who catches the knife? Who buys when the market is uncomfortable? Who steps in when the news is negative? Who keeps premiums firm when spot dips? Who keeps allocating when commentators are screaming top? That's where real demand shows itself. So if you're trying to judge whether this move over $5,000 is real, don't stare at the breakout. Watch the pullback. Because strong markets don't just rally, they refuse to break when they should. And weak markets don't just drop. They fail to recover when they try. Now, let me make this human for a second. A lot of you watching this have a complicated relationship with gold. You respect it. You want to own it. But you also don't want to be the person buying the top of a hype cycle. So you're torn. Part of you says, this level is historic. This could keep running. Another part of you says, this is exactly when everyone gets excited, and that's usually when it punishes people. Both instincts are valid. The mistake is letting that tension turn into impulsive decisions, because gold doesn't punish you for being cautious. Gold punishes you for being emotional and oversized. That's why we focus on behavior and signals, not predictions. Now let's talk about why the market feels different when flows are the driver. When flows dominate, price becomes less sensitive to perfect logic and more sensitive to positioning. That means you can have headlines that should push gold down. Stronger data, a temporary dollar bounce, a hawkish comment, and gold barely flinches. And then you can have a seemingly small catalyst that triggers a big move because it hits at the wrong time, when liquidity is thin or positioning is stretched. Flow-driven markets can be stubborn and jumpy at the same time. Stubborn in trend, jumpy in path. That's why you can get a week where gold looks unbreakable, followed by a day where it drops hard for reasons that sound stupid on Twitter. It's not stupid. It's the plumbing. Now here's the next nuance that matters for credibility. A lot of people hear China flows and assume that means gold is being controlled. That's not what we're saying. We're saying China can be a meaningful marginal participant, meaning the buyer that matters at the margin, the one that changes whether dips hold or break. Markets move at the margin. They don't move based on totals, they move based on changes. So if China-linked demand rises while others are neutral, it can create support. If China-linked demand cools while others are selling, it can remove support. And in some environments, that marginal effect is huge. Now, let's bring it back to what you should watch this week. And I'm going to keep this simple. The first thing to watch is how gold behaves when the news cycle quiets down. This sounds boring, but it's one of the best tells in markets. If gold can hold above $5,000 during quiet sessions, when there's no new drama to trade, that's strength. If gold only stays up when there's excitement and then bleeds lower in the quiet, that's fragility. Quiet strength is what you want to see if this move is supported by real demand. Second, watch how gold reacts to its first meaningful pullback after reclaiming $5,000. Not every pullback is equal. Some pullbacks are healthy pauses. They're the market taking a breath. Other pullbacks are the start of a failure sequence, lower highs, weak bounces, sellers showing up aggressively. A strong market usually pulls back and then finds support quickly, with buyers stepping in before it becomes a panic. A fragile market pulls back and can't find a bid without drama. And if you want a simple mental model for this, in a flow-supported market, the dip feels like it hits a cushion. In a fragile market, the dip feels like it falls through air. Third, watch the follow-through after the reclaim. Gold can pop above $5,000 and still be in a trap, because markets love fakeouts. They love taking a level, pulling in breakout buyers, and then reversing hard, making everyone feel like the market is personally trolling them. So you don't just want to break, you want to break and a hold. Then ideally, you want the market to build higher lows above the level. That's how you turn a headline into structure. Now let's talk about the biggest mistake people make right here. They treat gold over $5,000 like permission to throw discipline out the window. They size up, they chase, they get emotionally attached. And when the first pullback comes, they panic because their position is too big to sit with. This is where I'm going to be blunt. Most people don't lose money because they were wrong about gold long term. They lose money because they were forced out by volatility. And you get forced out when your position sizing requires the market to behave. Markets don't behave, especially not in a flow-driven regime where positioning and liquidity can whipsaw you. So if you're feeling that urge to do something big because gold is at a big number, take that as a warning. Urgency is how the market extracts bad decisions. Now, I want to connect the China flow signals back to the broader macro without repeating the same macro versus flow speech a dozen times. Here's the clean relationship. Macro creates the weather. Flows determine the path you actually walk through that weather. You can have a macro backdrop that's supportive and still get ugly pullbacks. You can have a macro backdrop that's mixed and still get an uptrend if flows remain persistent. That's why the flow signals matter. They help you understand what's happening beneath the headlines. Now let's make the China signals even more practical so they don't feel abstract. Shanghai pricing behavior is useful because it can show you whether Asia demand is firm, even when the West is hesitant. China ETF inflows are useful because they show whether allocation behavior is building. Reserve updates are useful because they influence psychology around dip buying and longer-term floors. You don't need 10 signals. You need a few that are meaningful and trackable. Now, I want to address the skepticism, because some of you are skeptical for good reasons. You've seen China is buying gold stories used as clickbait. You've seen people claim gold is going vertical because of some secret plan. You've seen the narrative abused. So here's the responsible stance. China-linked demand signals can be meaningful, but they are not a guarantee. They can support price, but they can also fade. They can contribute to resilience, but they can also coexist with volatility. And the market will tell you which is happening by how it behaves during pullbacks, not by how confident someone sounds online. Now, because this is meant to be a full voiceover, let me paint the picture of what this regime feels like from the inside. When flows are strong, the market starts doing this annoying thing where it refuses to reward certainty. If you're bearish, it won't drop cleanly. If you're bullish, it won't rally cleanly. It just grinds and whips and makes everyone question their timing. That's normal. That's what a market looks like when real demand is present, but positioning is still constantly being managed. And yes, that's also why people become obsessed with who is buying and where the buying is coming from. Because when a market doesn't behave like a normal headline-driven instrument, people look for a hidden driver. Sometimes that driver is just a big pool of steady buying. Sometimes it's multiple pools. And the evidence shows up in flow signals. Now let's talk about how this could play out from here without pretending we can see the future. Here are the clean scenarios. No drama, just a map. Scenario 1. Gold holds above $5,000 and starts building a base. This would look like pullbacks get bought, higher lows form, volatility gradually compresses, and the market starts treating $5,000 as a floor. Scenario 2. Gold chops sideways in a wide, ugly range. This is common after a big move. It's the market digesting. It feels like nothing is happening, but positioning is resetting and energy is building. Scenario 3. Gold dips back below $5,000, shakes people out, and then reclaims it. This is the stress test scenario. If flows are real, that dip gets bought and the reclaim holds. If flows are fragile, the dip becomes a breakdown. Scenario 4. Gold fails, breaks lower with follow-through, and the move above $5,000 becomes a bull trap. This would look like weak bounces, lower highs, sellers showing up aggressively, and the market losing its ability to recover quickly. All four are possible. Your job is not to predict which one happens. Your job is to watch what evidence shows up and not let your emotions write the script. Now, I want to give you a simple two-question filter you can use every day this week. Question 1. When gold pulls back, does it get bought quickly or does it bleed? Quick buying suggests a bid underneath, often consistent with real demand and allocation flows. Bleeding suggests the rally was more fragile, more headline-driven, more speculative. Question 2. Does the market behave stronger when it's quiet or only when it's loud? Strength in quiet periods suggests the bid is real. Weakness in quiet periods suggests the move needs constant excitement to survive. That's your filter. Now let's bring it back to the human side one last time. If you're a long-term holder, you don't need to nail the exact top or bottom around $5,000. You need to avoid doing something emotional because a number feels dramatic. If you're a trader, you need to respect that flow-driven markets can stay irrational longer than your patience, and volatility can hit you even when your thesis is right. So you need invalidation, you need sizing, you need humility. And if you're new, your job is simply to watch this week like a student of behavior. Watch how gold responds to dips, how it holds levels, and how the story evolves when headlines calm down. Because you'll learn more from one volatile stretch than from a month of calm drifting. Now, final comment prompt, and keep it simple. Do you think gold above $5,000 is being held mostly by flow or mostly by macro? Write one word, flow or macro, and that's it. If you want me to keep tracking this with a flow-first lens, Shanghai behavior, ETF inflows, reserve updates, follow for the next update.